President Trump is rebuilding his tariff wall. The bricks look familiar, but will the fallout? President Trump's latest round of tariffs have just been unveiled, with most US trading partners now facing duties of between 10 and 12.5% on their exports. After the Supreme Court blew a hole in his original tariff strategy back in February, Trump has found new tools to keep his signature trade policy alive. Feeling a sense of déjà vu? Well, let's ask James Smith, developed markets economist at ING. So James, Asian nations have condemned the tariffs but stopped short of retaliation. Have US trading partners effectively accepted that this is the new reality of doing business with America? Was anyone shocked?
I don't think anyone's shocked, really. I mean, this has been mooted for a few weeks as well, let's not forget. And I think what this really does is just solidify the tariffs that came in response to the Supreme Court ruling earlier this year. This is really cementing the sort of circa 10% tariffs that came in back then under a legal mechanism which is more watertight, less likely to be challenged in the courts. So I think it's really kind of continuity. Yes, I think trading partners obviously aren't happy about it, but as you say, I think this is the new normal for US trade relations.
Does that mean the inflationary impact is likely to be fairly limited? Can economists breathe a little easier?
I think so. And actually, one of the things we're seeing is the tariff impact on US inflation is dialing down. One of the things we look at is tariff revenue as a share of the value of everything the US imports in terms of goods imports. And that share, that sort of tariff percentage, if you like, tariff revenue is coming gradually lower, particularly now that we're getting big tariff refunds coming through in response to that Supreme Court ruling that we had earlier this year. I think if you net it out, in fact, in May, I think tariff refunds pretty much offset what the US was getting in fresh tariff revenue. So I think the upshot is that if that's sort of passing through to companies, then that should be helping their margins, and it should also take the pressure off them to raise prices of goods further. So I think at the margin, this is good news for inflation, but the inflationary impact of tariffs was already dialing lower.
Well, these tariffs may not be the last, but if rates climb back towards those 2025 levels, the economic risks become much harder to ignore. Do you think that'll give a bit of caution from President Trump's next approach with tariffs?
Well, I think the issue of affordability is clearly front and center in US politics right now, also with gasoline prices heading back above $4 a gallon. So I think, tariffs and the extra pressure that puts on goods is obviously a sort of part of that story. But equally, this is a big part of President Trump's economic agenda. Tariffs, this is something he's obviously talked about for a very long time. And also tariff revenue, cementing that is also important in terms of the fiscal stimulus that we got last year and kind of offsetting that in terms of the fiscal numbers. So I think tariffs aren't going away, but there is a question mark, I think, as to whether or not tariffs go higher from here.
Well, let's check in on the US economy. Initial jobs claims just fell to their lowest levels since 1969. After June's weaker than expected payrolls report, can we now put concerns about cracks in the labour market to one side?
The jobs numbers are definitely looking better. We've seen a bit of an upturn in private payrolls this year. If you look at 2025, all of the jobs growth came from a very narrow subset of US industries, particularly private healthcare. That's still true to some extent, but things have improved a little bit across the jobs market, albeit there's not a sort of big sign of heat entering things. The quit rate, for example, percentage of people leaving their job voluntarily is still pretty low. Wage growth isn't under any obvious upside pressure right now. But I think the fact that the jobs market has stabilized is enabling the Fed to focus much more squarely on inflation. And obviously, more recently, core inflation has been heading in the wrong direction, which is worrying the Federal Reserve hawks right now.
Well, Fed policymakers are weighing a renewed oil price shock, as you said. How do you see that balance playing out next week? A more hawkish tone?
Well, I think the renewed rise in oil prices is certainly unhelpful. I mean, we've seen in the recent Fed minutes from the June meeting, for example, the test that officials have really set is that, they're kind of talking about rate hikes unless inflation does come in better over the next couple of months. I mean, there are reasons to think it might do. I mean, we mentioned tariffs being more benign. Let's see what happens with oil prices. That's probably the main thing to watch between now and September, but there are other reasons to think inflation's getting better. Rental growth is slowing. I mentioned wage growth. So I think it's not a done deal necessarily that the Fed hikes rates in September, but that's obviously going to be any hints on that is going to be the main focus next week.
That was James Smith from ING. Don't forget you can watch more videos on Reuters.com.